Good evening, class, and welcome to our performance management class this evening. We are still discussing the topic variance analysis. We have talked about standard costing, and we also entered into variance analysis proper after talking about flex and fixed budgets. And we saw that we use the flexed budgets to compare with the actual results to get variances. Okay, so we've discussed a number of variances, like we talked about the direct material variance, we talked about the direct labor variance, then we talked about the variable overhead variance. So these are the three that we've talked about. Today, we'll be concentrating on the fixed overhead variance, cost variance, and then we will venture into the sales variance. Then if there is time, we'll try to see how we can do a reconciliation of these variances. Okay, so let's start with the fixed production overhead cost variances. Now, when we talk about fixed costs, we're talking about costs that do not change due to change of activity levels. So now, under fixed costs, we will learn that there is something called over and under absorption. Now, the variances for fixed production overheads are different from the variances for variable costs. Because with standard costing, the standard cost per unit of a product is the full production cost. Now, a full production cost will include variable costs and a fixed cost. And so the fixed costs are the cost absorbed into the production units. Now, it means that there is something called an overhead absorption rate, which is used to get the fixed cost. So we use the overhead absorption rate and multiply it by the direct labor hours in each production unit or so to get your fixed cost in the production unit. And so it means that if you over-absorb or you under-absorb, that means there will be variances. It means that what you budgeted for your fixed cost, you have a predetermined rate, which you have used already to calculate your fixed cost for production. And you now had an actual production, actual fixed cost spent. And you find out that the amount you spent in actual sense is more than what you have already absorbed into the production, then it means that you have over-absorbed. And what does that mean? It means that what you plan for production is higher than what actually happened. So over-absorption is an adverse variance, and under-absorption is favorable. Okay, so we look at the diagram here for the fixed production overhead. Now we have total fixed overhead cost variance. Just as we have total material cost variance, total direct labor, variable overhead, fixed overhead has a total fixed overhead variance. Now, fixed overhead variance is divided into two. We have the expenditure variance. So it means that you compare with what you actually spent with what was planned to be spent. Then you also have volume variance. So the volume variance plus the expenditure variance will give you your total fixed overhead variance. Now, volume variance can be divided into two. We have the efficiency variance and we have the capacity variance. So the efficiency variance plus the capacity variance will give you your volume variance. And when you have your volume variance, you can now add it to your expenditure variance to have your total fixed overhead cost variance. So that means we have one overall variance, which can be broken down into three smaller parts: expenditure variance, efficiency, and capacity. So that's what we'll be looking at now in our variance analysis. So you see here, sorry, I mixed up something here. When you under absorb production overhead, you have an adverse variance. And when you over absorb, you have a favorable variance. So when there is an over absorption, you have favorable variance. That means what you actually spent was more than what you plan to spend. So you have taken more, you have absorbed more, and that's a favorable variance. Now look at this question here. Look at the format here. Fixed overhead, fixed production overhead, total cost variance. Now, you have your fixed production overhead absorbed in the period. How is it calculated? You look for the actual number of units produced multiplied by fixed production overhead per unit. So of course, you must have gotten your overhead absorption rates and multiply it by your direct labor hours. That will give you your fixed overhead per unit. So you have overhead absorption rates multiplied by the number of labor hours per unit. That will give you your fixed overhead per unit. You multiply it now by the actual number of units produced. That will give you your total standard overheads, fixed production overhead. Then you now compare it with the actual fixed production overhead you incurred. And so if what you incur is higher than what you actually planned, then you have over-absorbed. And so you are going to be having an adverse variance. Sorry, you have under-absorb rather, and you have an adverse variance. So when you why am I getting this mixed up? When you under-absorb, you have an adverse variance. If you over-absorb, then you have a favorable variance. So it means that if the quantity here, this one you planned, is higher than what you actually spent, you have over-absorbed. It means this is the standard that you have decided to record in your books. But you now decide, you now went to buy or spend something lower than what you have planned. You have over budgeted, you have over absorbed, and that is, okay, that is adverse. Adverse. Sorry, that is favorable. That is favorable because you spent less than what you planned in your production. Okay, let's look at it now in the question. Let's go back to our Lagos Manufacturing Limited that we have been doing. Let's demonstrate this total cost variance. We have budgeted fixed production overhead of 2,880,000 naira. Now, that's the overhead budgeted. Then we have the budgeted production hours. And we see here that the budgeted production volume is 1,200 units. Remember from our last example, that is what we budgeted to produce. And the labor hours is 4 hours per unit. That's the standard labor hours. Now, what is going to be our overhead absorption rate? Our overhead absorption rate will simply be what we have budgeted to spend divided by the total labor hours. The total labor hours we are given is 4,800. Remember from our last class, 4,800 hours was used for labor. So when you divide it, you have 6,600 naira per hour. And this 4,800 can also be calculated here. 1,200 units multiplied by 4 hours per unit will give you 4,800. So you see our overhead absorption rate is 600 naira per hour. Now, how do we get our standard fixed production overhead? Okay, 600 naira is what we are planning to spend as fixed cost in 1 hour. And if 1 unit takes 4 hours, that means 4 hours times 600 naira per hour means 2,400 naira for 1 unit. So that is what we plan to spend for 1 unit. Now, if we decide to use this as our plan for 1 unit, let's get down to our actuals. The actual fixed production overhead. So this was what was actually spent. We spent 2,500,000 as against this 2,880,000 that we budgeted. So we spent something lower. Now, what is our actual production? Our actual production is now 1,000 units. So remember, we budgeted for 2,200,000 because we planned 1,200 units. But now your actual production is now 1,000. So how will it now be? How will you calculate your total cost variance? Now, your fixed production overhead absorbed in the period will simply be you spent for 1,000 units. That's the number of units you spent for. And how much did we plan to spend per unit? 2,400. So when you multiply 2,400 by 1,000, you are getting 2,400,000. 2,400,000 is what is your flexible budget telling you. That is what you have planned, going by what you've budgeted. This is what you have planned for 1,000 units. And actuals you spent 2,500,000. So what happened? This actual is what you should have budgeted, but you budgeted something lower than what you spent. So if your standard is higher than your actual, that's good. It's favorable. But now your standard is lower than the actuals. That means you under budgeted. You have under absorbed. You should have absorbed 2,500, 2,500,000, but you went ahead and absorbed 2,400,000. So that means the 100,000 which you failed to absorb is under absorption, and it's an adverse cost variance for you because you spent more than you budgeted. Now that's the total fixed overhead variance. So now, what gave rise to this 100,000 under absorption? So we'll now have to explain using the other smaller variances, subdivisions, to see how we got that 100,000. So we want to split it down now into their components. We have fixed overhead, fixed production overhead, expenditure variance. Now that's one part of the fixed overhead that we'll be discussing. Now, it simply calculates the difference between the budgeted fixed production overhead and the actual fixed production overhead expenditure. Now, I said before that we usually use a flexible budget in our variances. But when it comes to fixed costs, we have the fixed budget. We use fixed budgets, and we also use the flexed budget in our variance. So we use a combination of the two. And so this is one example where we will now use the fixed overhead, fixed budget. But in all other variances, direct material, direct labor, variable overhead, we don't use the fixed budget, we use the flexed budget. So now let's see the format here. Fixed production overhead expenditure variance. Now is you are going to use the budgeted fixed production overhead and the actual fixed production overhead incurred. The difference is simply the variance. So let's look at our example here. The fixed budget tells us that we plan to spend for 1,200 units. And this is the amount we plan to spend, 2,808,000. We don't care if the actual units produced is 1,000 units. What we care is we've planned for 1,200. This is the amount we are planning for 1,200, and we actually spent on 1,000. This is the amount we spent on 1,000, 2,500,000. And so we have a favorable variance of 380. Wow. So that favorable variance is fixed production expenditure variance. It means this is favorable. We plan to spend for 1,200 units, 2,880,000, but now we spent less. So it means that you have over-absorbed, so to speak. You have over-absorbed, so to speak. So when you over-absorb, you have a favorable variance. Because, so I wanted to look at it this way. You over-absorb, that's good. You under-absorb, that's bad. So now, fixed overhead expenditure variances can be calculated for control reporting for other overheads as well as production overheads. For example, an administrative fixed overhead expenditure variance is the difference between the budgeted and the actual fixed administration overhead. We can do the same thing for selling and distribution. So what we have in the fixed budget compared with what we have at actual, you will see if you have an expenditure variance. So we said fixed overhead is broadly divided into two. The total variance is broadly divided into two: expenditure variance and volume variance. Now, let's look at the volume variance. Volume variance, we can calculate one result for volume variance, or we can break it down into its components. Now, the fixed overhead volume variance measures the amount of fixed overheads that is under or over absorbed because of the fact that actual production volume differs from the budgeted production volume. Okay, so it's still making use of the fact that you planned to use 1,200 units, but now you are spending on 1,000. The volume variance is measured, first of all, in either units of output or standard hours of the output. The volume variance is in units is converted into monetary value, and the appropriate standard fixed overhead cost per unit, which is the overhead absorption rate, is then applied. Now let's look at the format here. We have the actual number of units produced. So this is the actual number of units produced. Then we have the budgeted production. That's the budgeted number of units. Then you find a difference. The difference is called the fixed overhead volume variance. That is in units. They now multiply it with the standard rate per hour. And the result will be your fixed overhead volume variance. Let's look at this question here logically and see how it plays out. It is still the same question. We budgeted to spend 2,880,000, planning to use 4,800 standard hours. Overhead absorption rate, we've calculated it as 600 naira per hour. Now, our standard fixed production overhead per unit, like before, we did it at 2,400. Now, what is our actual production overhead? Our actual production overhead, we said it was 2,500,000, still as before. And we actually produced 1,000 units, still as before. Now, what is our volume variance? Now, how is it different from expenditure variance? We're going to see now. First of all, let's look at the number of volumes produced. 1,000 was produced, but you budgeted for 1,200. Now, when you budgeted for 1,200, that means the difference in volume is 200. That difference is an adverse because the actual number, the standard is now higher than the actual. The standard is higher than the actual. So it is an adverse. So you are reversing the law. We used to say that if the standard is higher than the actual, it's favorable. But now the standard is higher than the actual. The budgeted, so to speak, is higher than the standard, and here it is adverse. All right, so we have 200. So what is the standard overhead cost per unit? It's 2,400. So when we multiply it by 200, we have 480,000 naira. Now 480,000 naira is the total volume variance. Fixed production overhead volume variance. It's adverse, 480. Now if you look at it clearly, we have 380 favorable and 480 adverse. If you are to add them together, 380 minus 480 will give you an adverse of 100,000. And if you look at the total fixed overhead production overhead variance, it's an adverse of 100. So you categorize it that, oh, the expenditure variance is favorable while the volume variance is adverse. But we'll still need to break down that volume variance into its components so that we can understand how we can derive our efficiency variance and our capacity variance. All right, a volume variance might be due to two reasons. The company has worked a different number of hours than they budgeted. That has efficiency. So they have operated at different capacity. Or two, during the working hours, the company has operated at a different level of efficiency than that to the budget. Okay, sorry, the first one was a different capacity, then the other one is a different efficiency. So there's capacity and there is efficiency variance. So when we add this efficiency and capacity variance, we should be getting our volume variance. Now let's look at the efficiency variance. This is exactly the same in hours as the direct labor efficiency variance. So it is the same thing we did in labor variance. So we are taking a leap now from our direct labor efficiency variance, and we're putting it down here in fixed production efficiency variance. So let's see here. Standard hours used to make actual production. That was what we did in labor. Actual hours used to make the actual production. The difference would be an efficiency multiplied by the standard cost for fixed overhead production. That should give you an efficiency variance. Let's look at the example here. Okay, so standard production overhead cost per unit, we know that to be 2,400. We've been using this figure throughout since today. Actual production is 1,200 units. We already know that. Labor hour paid for is 4,200. And labor hours worked for is 4,100. So we're going to be using the labor hours we worked for efficiency. We're going to be looking at labor hours worked for. So it means that if we are to make 1,000 units, actual units, at a cost of 4 hours, at a level of 4 hours in 1 unit, it means if 4 hours is used for 1 minute, for 1 unit, for 1,000 units, we'll be spending 4,000 hours. So that is what we plan to use. But actually, in making the 1,000 units, we worked for 4,100 hours. Wow. So what happened? The difference now is an adverse variance. It means the actual is higher than the standard. So when we are looking at fixed overhead expenditure, if the actual is higher than the standard, then it's good. But here, the actual is higher, it's bad. So it's adverse. So we have an adverse of 100 naira, 100 hours. So how much is the standard hour per standard amount per hour? 600 naira per hour. So you're going to multiply 600 by 100, that gives you 60. So your adverse variance here is 60,000 naira. So we have been able to explain the 480 adverse. We've gotten 60,000 was due to efficiency because we worked extra 100 hours more than we planned. Now let's look at the production capacity variance. Now, in capacity variance, this is the difference between the budgeted and actual hours worked for, excluding any idle time. So it is converted into a money value at the standard overhead cost per hour. Now look at the format here. Number of hours worked for, that's the actual number worked for. Then what is the budgeted hours that you're supposed to work? You minus and you get the difference, which is called capacity variance. Then you multiply it by this cost per standard hours. So we're going to see the difference now between what we did here and what we are going to do now. All right, so let's see the difference here. All right, so you have your budgeted production overhead. All this information has been given to us. That's what we have been using since this class. Now we are asked to look for our fixed production capacity variance. So how do we calculate it? So we looked at it again. Actual hours worked is 4,100. But what is the budgeted hours that should be worked? Okay. The budgeted hours that should be worked is 4,800. Based on the fact that we planned 1,200 units. So you see here now that we are using the fixed budget. So it means that there are two places where we use the fixed budget in our variance. One of them is at the expenditure variance. We use the fixed budget. And now at the capacity variance, we are using it. So we are planning to spend 4,100. So the difference now is in efficiency variance, we use the actual number of units and we say if we have used the flexed budget, we'll be spending 4,100 now, but we are going by our fixed budget. It means that we planned 4,800. That is the amount that will be budgeted. But what was actually worked is 4,100. Now the difference between the actual amount, actual hours worked with the budgeted hours worked is 700 hours, which is the capacity variance. Now, when we multiply it by 600 naira, which is standard cost, we have an adverse variance of 420,000 naira. Now, that's the difference, because we are planning to explain how we got our 480. So we saw 420 now and 60 the other time. So that's it. What are some of the possible causes for fixed overhead variances? Some of them is for adverse, poor control over overhead spending. That is for adverse. But for having a favorable variance, you have a good control over your spending. Then there is poor budgeting for overhead spending. So poor budgeting is different from poor control. You may have a good budgeting, but your control may be bad. But now you have a poor budget, you didn't budget it well. And if the budget is for overhead expenditure is unrealistic, then there might be expenditure variance due to poor planning. And so you may have what they call the adverse variance because of poor planning. Then there may be an unplanned increase or decrease in items of expenditure for fixed overhead production. For example, you might have an unexpected increase in rent, and that will affect your fixed overhead in rent. Then look at volume variance. A fixed overhead volume variance can be explained by anything that's made actual output different from the budgeted output. For example, efficient working by direct labor would lead to favorable variance, maybe because they were able to save time by working efficiently, or they're able to reduce waste. So when the direct labor, anything that gives a direct labor favorable variance will also give a favorable variance for volume. Working more hours or less than budgeted would give you adverse or favorable. Unexpected increase or decrease in demand for a product would lead to that. Even strike action, breakdown in machine, and so on. So these are some of the reasons for variance in volume. Okay, later I'm going to give you a compact formula that can be used for variance analysis, such that when you are dealing with any of the variances, you don't need to think too much. Just remember the formula and you are good to go. So before I move to the sales variance, let me tell you one thing. We mentioned that the direct material variance is the base, what you need to remember. Once you can remember your direct material total variance, break it down to rate and usage, price and usage, then you are good to go. When you are doing your labor variance, simply convert your price to your rate, usage to efficiency. You are good to go. Do a copy and paste for direct labor to variable overhead. The variable overhead will say the expenditure variance, which is okay to replace the rate variance with expenditure variance, but it will retain the efficiency variance that is being used in direct labor. Now, when we are going to fixed overhead, we know we are going to be using both flexed and fixed budgets. So you'll be seeing standard and you'll be seeing budgeted. So when you see standard hours, it means we are using the flexed budget. When you see budgeted hours, it means we are using the fixed budget. So I'm going to give you a 1 or 2 page summary for all these variances so that looking at them, it will be easy for you to understand. Now let's go now to the sales variances. Now, sales variances, unlike cost variances, are not recorded in standard costing system. So when you are saying a costing system, you will not see sales. Although, yeah, you will see selling price, but sales variances are not recorded in the standard costing system of accounting, the cost ledger. However, sales variances will be included in the reports to management. Because without sales variances, we cannot reconcile the actual profits with the budgeted profit. Now take note here, we are supposed to reconcile actual profits with budgeted profits and not with standard profit. So what's the difference? Budgeted profit is the profit that comes from the fixed budget. That fixed budget is the budgeted, that profit from the fixed budget is the budgeted profit. If we say standard profit, then we'll be looking at either 1 unit or actual production units. So we're going to be reconciling fixed budget with the actual result. So without sales variances, we cannot do this effectively. Now, there are 2 sales variances we are going to look at. The first one is sales price variance. Now, your sales price variance is just like your costs price variance for direct materials, almost. And your sales volume variance is almost like your fixed cost variance in volume. So let's look at your sales price variance. The sales price variance shows the difference between the actual sales prices for items that were sold and their standard sales prices. Now, to calculate this variance, you should take the actual items sold. Now, remember when we did price variance for costs, we looked at actual quantities sold. Now we are looking at the same actual quantity produced. Now in sales variance, we're looking at actual quantity sold and compare it with the revenue with the standard selling price. So we are still using the flex budget here. Now look at the sales price volume variance rather. To get the standard, you need to get the actual sales volume and multiply it by the standard selling price. Then the actual revenue will be the actual sales plus the actual selling price. That will give you your sales variance, sales price variance. So you see here, it is the price that varies. The actual sales quantity is the same, but the price you sold them actually varies. All right. Now, whenever standard is higher than actual. Now that's bad. Because unlike costs, you want to reduce the actual spending over your budget. But in sales, you want to increase the actual sales than your budget. So there's a favorable sales price variance if the units that were sold is more than the standard. If the selling price for the units sold is more than the standard you keep. So nobody will want to plan to sell something for 500 naira and you now sell it for 400. Well, that will be an adverse. So if you sell it for 600, you've sold it for higher than what you set as standard, and that's favorable. Let's look at example. We are using the Lagos Manufacturing Limited. We are still using the same parameters, but certain things that have been added. All these, remember our standard costing, we derived all these things we are doing from that first question that we got in standard costing. Our budgeted sales volume, we budgeted to sell 1,000 units, remember? But we now actually sold 900, if you remember the first question. And we budgeted to sell them at 15,000 naira per unit. But your actual revenue happens to be 12,600,000. What does that tell us? That our selling price will be 12,600,000 divided by 900, which gives us 14,000 naira. That means our selling price is going to be 14,000. How do we calculate our price variance? We said we are going to be using the actual number of units sold, which is going to be 900 multiplied by 15,000 naira, and that's going to give you 13,500,000. The actual sales is 900 multiplied by 14,000. That will give you 12,600,000. So that will give you 12,600,000. So the sales price variance is adverse because you sold lesser than what you budgeted. If you look at it critically, 15,000 naira selling price minus 14,000 selling price is 1,000 naira adverse. So the selling price alone is 1,000 naira adverse. If you are to multiply it by 900 units you sold, you have 900,000 adverse. So that's what we have here, 900,000 naira adverse. Okay, so what about sales volume variance? We've seen sales price variance. Now, sales volume variance, take note. A sales volume variance shows the effect on the profits of the difference between the actual sales volume and the budgeted sales volume. So we are going to be looking at what is the effect of the difference in volume on the profits. So in a standard absorption costing system, the sales volume variance might be called a sales volume profit variance. So you'll be saying either profit in our formula or contribution mix. Look at the format here. Budgeted sales volume, which is the fixed budget. Actual sales volume, find the difference. Now, you multiply it by the standard profit per unit. Now, standard profit, you know, in our fixed budget, we had a standard profit. which was the same thing in our flexible budget. So you see here, standard profit is the same because okay, sorry, it's not the same. Is the closing stock I was trying to say. Closing stock happens to be the same, but standard profit is not the same. Okay, but you're going to see how we are going to get our standard profit per unit in this question here. Let's look at this question. Everything is still the same. Budgeted sales volume, 1,000 units. Now the actual sales volume is 900. So you see here, budgeted is from the fixed budget. Actual sales volume is from the actual result. So you see there is a difference of 100. It's an advance because you're supposed to sell up to your budget, but you sold lower than that. What is the standard profit per unit? Remember, we calculated it as 4,800. Remember the first time we were calculating the first fixed budget we did, our profit was 4,800 per unit, the standard. So that is what we use. So that standard cost for 1 unit, that profit we got for 1 unit, that is what we are using to multiply by 100, and that gives us 480,000 sales volume adverse variance. So you see the volume variance is favorable if actual sales is higher than the budgeted volume, and adverse if actual sales volume is below the budget. All right, so what are some of the possible causes for these variances, sales variances? Sales price variance could be caused by actual increases in prices charged for products which were lesser or higher than expected due to market conditions. So selling prices, the cost for the products were higher than or lower than what you anticipated because of market condition. Then your actual selling price will either be higher or lower than the standard. So you see the cost to bought some items may be higher or lower, causing profits to reduce or increase, or your selling price may increase or reduce. Or sometimes competitors could reduce their price, which may force the company to reduce their own prices for their products. The volume variance, the actual sales demand may be more or less than what you expected. So maybe you budgeted to sell 1,000 naira, but the market is demanding 900. So your sales volume variance will be 100 in volume. Then the sales force worked well and achieved more sales than the budget. So maybe they shoot their target, exceeded it in volume. Everybody is happy, they're getting a favorable variance. Perhaps you might have an advertising campaign which brought huge success than expected. And so you increase your sales, and that will account for favorable variance. And a competitor went into liquidation, and the company attracted some of the former competitors' customers. So maybe there are only 2 or 3 competitors. Let's say in the telecommunication industry, we have about 4 competitors. And if one of them goes liquid, maybe it is on liquidation, the customers that belong to that company will have to migrate. And you may see the other 3, they have increased customers, and so they may have a sales volume variance of favorable nature. All right, so we've seen how variances work. We saw cost variances, and now we've looked at sales variances. And we say the sales variances are two: price variance, volume variance. The price variance still looks at the selling prices in relation to the actual number of units sold. So we are looking at the flexible budget when we're looking at sales price variance. But when we're looking at sales volume variance, we are also looking at the fixed variance, the fixed overhead, the fixed budgets with the fixed budget with the actuals. And so when you compare the fixed budgeted volume with the actual volume, you have either a favorable or an adverse variance. Let's look at the interrelationship between the variances. Okay. We've looked at some of the causes for individual variances. Now, the reasons for variances might also be connected, and two or more variances might arise from the same cause. This is known as an interrelationship between variances. Let's see an example here. One variance might be favorable and another variance might be adverse. Now, taking each variance separately, the favorable variance might suggest good performance and adverse variance might suggest bad performance. However, the two variances might be interrelated and the favorable variance and the adverse variance might have the same cause. Now, when this happens, management should look at the two variances together in order to assess their significance and decide whether to give control action. Now, they said, let's look at the example here given below. A favorable sales price variance and an adverse sales volume variance might have the same cause. If a company increases its selling price above the standard, the sales price variance will be very favorable, but sales demand might fall. And so the sales volume variance will be adverse. So you see, you increase your price more than the standard. Yes, you have a volume, the price variance favorable, but the demand, demand and supply, where your price is higher, the demand might be lower. But if your price is lower, the demand might be higher. So if you have an adverse sales price variance, you might have a favorable volume variance. Similarly, in order to sell more, you may have to reduce your prices. This is just what I just said. All right, now in material and price and usage, now let's see. A material price variance and usage variance might be interrelated. For example, a company decides to use a material for production that is more expensive than the normal or standard, but easier to use and better in quality. So because it is more expensive, there will be an adverse price variance. However, a consequence of using better materials might be lower wastage. And if there are lower wastage, there will be a favorable material variance. So that's it. Let's look at labor rate and efficiency. If there's a change in the grade of workers used to do some work, both the rate and efficiency variances might be affected. For example, if a lower grade of labor is used instead of the normal grade, you might be paying them a smaller money and be getting a favorable rate variance. But you see, they are lower grade, they may give you less efficient work, may take you longer time to produce, and might also give you, they might create high waste. And so your efficiency variance will be adverse. Okay. So sometimes you need to note that when they are having this kind of interrelationship, you need to weigh the factors. Which will you rather want? Would you rather want low-grade workers working for you for a cheap amount and you get inefficient results? Or will you want to pay higher to get good grade of workers and get adverse price variance, but good efficiency? Which will you favor? Look at even materials. You might want to go and buy a cheap material, very cheap. So you have a price variance that is cheap. But when you are using that material, because of poor quality, it results to plenty waste. So they are independent, they are interdependent. Now we come to the most important thing here, reconciling the budgeted and actual profits, looking at the standard absorption costing. All right, so let's look at the purpose for an operating statement. A management report, also called an operating statement, might be prepared, showing how the difference between the budgeted profit and the actual profit could be explained by we'll be looking at the purpose of the operating variance here now is to report all variances to management so that management can assess the effects they are having on profitability. So you have to see the effects of these variances on the profit we are having. So let's look at the standard format for an operating statement. Operating statement. What is the standard format? First of all, we bring in our budgeted variance and budgeted profits because we plan the budget first. So this is our fixed budget. We start with that because that is what we would have calculated first. 4,800,000. So the first thing to do is bring your sales variances first. If your sales variance is adverse, you less it. If it is favorable, you add. One thing I have noticed about sales variance is that if the price variance is positive, there's a tendency that the volume will also be positive. If one of them is negative, there's a tendency the other will be negative. It may not work in all cases, but in some of the variance questions I've solved, it happens that way. So you see here now that this is our actual, the budgeted profit we had. This was the sales variance, price variance, 900,000. The volume variance we just solved, 480,000 adverse. So this brings down the budgeted profits to 3,420,000. Then you come with the cost variances. So all the adverses, you're going to less them. All the favorable, you are going to add. So it's good to separate the favorable from the adverse. In our direct material price variance, we have a favorable price. That's good. Usage, we also have good, favorable. So you see, this interdependence did not happen here, whereby one is good and the other is bad in the case of material. So you see here, we got a good bargain price and we manage the resources well. Now look at labor. So I wanted to look at another kind of interdependence. Take note, we said we got good price for our materials. That's why we got a favorable variance. And our materials we have managed well, reduce waste, efficient use of the time, efficient use of materials. We avoided waste, 150. Now, direct labor rates. We have an adverse, 21,000. What does that mean? It means we spent more than what we could have spent. Could it be that we paid more for better service? Could it be that we spent more? Okay. Now, it could be because if you use a good grade, a higher grade, they are going to reduce waste in materials. So that is another way that relates. You pay more for good quality people and they reduce your waste. So you can see here, you have material favorable variance is 150, but you spend only 21. So which will you rather have? I would rather spend more money to retain this 21,000, spend 21,000 for good people so that they can save me 150. All right, direct labor efficiency, 50,000. What could that be? It could be that they didn't use their time well. The efficiency, labor efficiency, the hour that they are supposed to have used was not used well. So that means the total number of hours that was budgeted for them, they exceeded it. They exceeded it. Okay, so you're supposed to use a particular amount of hours and you used more than that. Now, there is direct labor idle time. Idle time. Although we didn't calculate idle time, what is idle time? Idle time is the difference between the number of hours worked for and the number of hours we are paid for. So you are paid for 4,200 hours, so to speak, and you worked for 4,100 hours. That means the difference is idle time. So the time that you are paid that you didn't work is idle. So if you remember, in our question that we are given 4,200 hours paid for, 4,100 hours worked for. So the idle time here should have been 100. Perhaps due to inefficiency, it was they increased their time. Perhaps they increased, instead of making it 4,100 hours, they now work for 4,150 hours. So that could be why the 50 is direct labor adverse. And there's an idle time, 50. Okay, so variable production overhead expenditure. We know it's going to be adverse here because we plan for 1,200. And now we spent we now spent money on fixed, okay, this is variable production. Okay, I was explaining fixed. variable production overhead expenditure is an adverse. All right. So we said anything that will affect direct labor is the same thing that will affect variable overhead. So if direct labor rate variance happen to be adverse, it could also have a telling effect on the variable production. The same thing too with the efficiency. So let's go to the fixed overhead. Fixed overhead expenditure variance. Why is it favorable? 380. We planned to spend money for 1,200 units. If I can remember, it was, how much did you remember? Planned to spend for 1,200 units, 2,880,000, I think so. So you see, expenditure variance, we planned for 1,002, and we actually spent for 1,000. And the difference, that was 2,500,000, while we planned for 2,880,000. So 2,880,000 minus 2,500,000, that was what gave us that 380,000 naira favorable. And of course, the fixed overhead efficiency. So fixed efficiency now, we use the same way in direct labor. So you can see here, your direct labor efficiency was adverse, and it's also affecting your fixed overhead efficiency variance. It's adverse. Here, 60. Okay. Then your production overhead capacity variance, we solved it there to be 420,000 naira adverse. So we add this to it, became 480, remember. So all your favorable variance gave you 772. All your adverse variance gave you 746. So what do? Your favorable is positive, adverse is negative. So simply 772 minus 746. That gives you this 26. So since favorable is bigger than the adverse, I'm going to give you a positive figure of adverse. So you have here 3,420. We have to now add 26,000. It gives you 3,446. That is your actual profit. Now let me see if I can get that actual profit we did and see if it really balances. Let's see if it really balances. Hold on, I'll get to it in a moment. Okay. Hold on a moment. Very good. I'm down here to it now. Very good. So you see, we were comparing this fixed budget. We started with 480, and we arrived at 3,446. So we saw that it is the variances that explains the difference. Variances explains the difference. So if your actual profit is not exact as what you got in your actual profit statement, then that means there's something wrong with your variances. That means one or two variances are not correct, because they should balance, all things being equal. So I wanted to look at variances again. Look at how to balance or reconcile variances, the cost variances, sales variances, look at them again, and now look at how this profit statement is going to help us in reconciling the variances we have. So far, so good. This is where we are coming to the end of our class for today. So we have seen the fixed overhead variances. There's a combination, the use of fixed and flexible budgets. And we remember the efficiency variance for fixed overhead is the same efficiency variance for direct labor. So we take notes, anything that affects direct labor efficiency, also affect fixed overhead efficiency. And we saw the volume and the expenditure variances. Then we looked at the sales variances, and we saw that there is price variance, which comes from actual units sold, and we're comparing the standard selling price with the actual selling price. And so we see in sales variances, the actuals is expected to be higher than the standard to get a favorable variance. Then we now looked at the sales volume variance, and we said it has a direct impact on the profit. So we are going to use standard profits. So the volume in sales that was budgeted and not actually sold, find the difference, and you use the standard profit margin. If in your question you are given contribution margin, remember I said contribution because that was an error. Contribution margin, you use it because contribution leads to profit. So if you are not giving profit, standard profit, but you are giving contribution, use the contribution figure. We now saw how to reconcile your budget, the fixed budgets with the actual budget, and the variances we got by using the flexible budget standard and with the actual, and the variances we had using the fixed with the actual gave rise to these explanations, which are called variances that actually reconcile the two. So play with this reconciliation, because if a question is going to come out on variances, you might be given variances and be asked to reconcile. They might give you variances like this and ask you to give the possible causes for those variances. They might also be asking you questions on interdependency. Or they may be asking you to calculate the variances and then reconcile. So you don't know where the question will come from. So it's good to be prepared to be forewarned, to be forearmed. Thank you so much. This is where we are going to stop for today. In our next class, we will go into something called advanced variance. So we're going to take our variance a step higher to see how advanced variances look like. So please learn this very well so that when we start the advanced variances, it will be easy for you to understand. So I appreciate every one of us who has come to class. See you again in the next class. Do have a lovely day.